Hello and welcome back. My name is Evan Clementino here at CBBB, and today we are going to focus on the most important financial statement that you need to understand to maximize output in your business, and that is the income statement, or what you might know as the profit and loss statement, the P&L. There are so many different ways we can go into the conversations around P&L. So today I just wanted to keep it super high level. This should be like the first video in a series of profit and loss based stuff that you can follow along with. And today, what I want to focus on is simply how to read the financial statement, how to read the profit and loss, and how to identify whether yours is in decent shape or not. So let's get right to it. Here's an example profit and loss statement. And as you can see right now, it's just the accounts. I decided to keep the numbers covered because I just want to focus on the flow of it and the sections, okay? The first and most obvious section here is the revenue section, and I'll highlight that in green. That's all your money coming in, right? And it can come in through different sources, but realistically, your revenue or your total revenue is going to be the total revenue. It's going to be the total amount of revenue that you brought in that focused period of time. Next is your first categories of expenses, and this is your COGS, or what's called cost of goods sold. We're going to circle back to the importance of this one, but it's first important to recognize how it's separated from the other expenses, which may be called your operating expenses, your indirect expenses, or what we like to call overhead. And I'll highlight that here. And essentially, your profit or your net profit is calculated as your revenue. So revenue minus expenses. Here, I'll write it like this actually. Revenue less COGS less operating expenses equals profits. Okay. Now that's a simple formula. Obviously, you can include tax into the equation here. You have your tax, which is subtracted from your before tax profit to get your after tax profit. But for now, let's keep it with this simple formula. Revenue minus expenses equals profit. Now, if you're following along with your financial statement, your profit and loss statement, I want you to identify these three categories. Is your revenue accurate? How do they separate revenue? Do you make revenue through different streams, and is that accurately captured by your bookkeeping process? Are your change orders accurate? Do you separate your revenue through change order revenue versus your initial contract revenue? Do you make other revenue like media partnerships, sponsorships, service calls, or a specific line of activities that are kind of different from your main offering? That should all be laid out separately in these revenue sub accounts, okay? Then when you get into your cost of goods sold, this is more or less the standard breakdown of your cost of goods sold. You have direct labor and direct materials. And then this report also specifies subcontractor expenses, equipment rentals, and then your other random cost of goods sold. You may be asking, I don't sell goods. What does cost of goods sold mean? Essentially, what cost of goods sold is, or COGS, is the expenses that are specifically attributable to a construction project. So where your truck payments, your fuel, your insurance, those get spread over different projects, right? You pay those expenses regardless of the work that you're doing. These expenses here, your direct labor and your direct materials, those go into the completion of specific projects. You buy 2x4s, drywall, you buy sod for a specific project, and that gets captured in direct labor and direct materials. For direct labor, you're capturing the exact wages or salaries that go into providing a specific job. And then, as I mentioned earlier, your operating expenses, like your vehicle payments, your fuel, your insurance, like these things are kind of expenses that you're going to incur regardless of the level of work that you're doing, or they can't be attributable to a specific job. So those are called your overhead expenses. And essentially that split of COGS versus overhead, you're going to have to consider how those are worked into the price of your job, and making sure that your profitability on a job covers the overhead expenses that aren't necessarily contributed to that specific job, but that are expensed through the business over the course of the entire year. Okay. So you have your revenue, you subtract your cost of goods sold, and you get your gross profit. So that's the profit after all of your direct expenses, your cost of goods sold, are incurred. And then your net profit before tax, takes your gross profit and subtracts the overhead expenses. Then your last line here, you can just subtract the tax, which is essentially taken out at the end of the year. And then you get your net profit after tax. That's your bottom line. That's your, when someone asks you what your profit margin is, what your profitability is looking like, that's the line they're talking about. So now let's put some numbers on it here just to give it some more context. This company here, you can see that they made 815 grand in total revenue, and most of it comes from their contract revenue. They get a little bit of change order revenue, but just providing their meat and potato services, that's what gives them their 815 grand. Now you have cost of goods sold that racks up to 441 grand. You can see that the main driver here is materials, second is labor, and then you have a couple other smaller ones. If you bring subcontractors to the site, you rent your equipment, etc. You can look at this gross profit margin and say, okay, right here, this is how much money I come away with to cover my overhead expenses. So I take my total revenue and I subtract the cost of providing that service. This is what's left over to pay for the other stuff, the truck payments, the insurance, the bookkeeper, that kind of stuff. And then you can see all those expenses are laid down here, the long list of overhead expenses. There's your total overhead expenses, and here's your total profit before tax. Now, tax is calculated more or less based off of that net profit before tax amount. So you'd apply your tax rate to that net profit before tax, as you can see I did here. And here's your net profit is the before tax minus the tax is your net profit after tax. That's the flow of the income statement. It's really as easy as that. What I wanted you to take away from this video today is the accounts, right? The categorization and the organization of this statement. If you notice that there's not a clear cost of goods sold section in your profit and loss statement, you need to look in your bookkeeping system, your bookkeeper and your accountant to make sure that that information is being divided up. Realistically, that's the information that's going to help you make decisions in your business. So we want to make sure that data is being captured. Some things I want you to look out for and some things I want you to understand about the cost of goods sold. The first one is the direct labor. So first, you have to ask yourself, how are employees' hours being tracked, and are they being tracked to specific jobs? Because oftentimes, employees are just sending their hours to the bookkeeper or clocking in on an app, but they may not be putting the job, like the actual project that they're working on, they may not be inputting that into the system. So if they're not doing that, you're not capturing the hours spent on specific jobs. Also, consider your salary as the owner. Are you keeping track of what hours you are working on specific jobs, or do you just collect your salary regardless of the site that you're at? We'll touch on that again in a second. Now let's look at direct materials. So your accountant or your bookkeeper might be categorizing direct materials and other supply purchases all under direct materials, or they might not be. But you want to know exactly what that direct materials total is made up of. Because yes, the studs that you bought, the drywall, or if you're doing a landscaping project, the sod that you bought, those are direct materials. It's clear as day. But when you look at things like blades for X-Acto knives or saw blades, these things could be confused as materials when in reality they are supplies that get worked into the price of all of your jobs in the season, not just one specific job. So your bookkeeper needs to be accurately dividing those expenses as direct materials versus something like tools and supplies down here. Okay. And that brings me back to the direct labor versus owner salary one. You can see here, sorry, that line, that's your salary there. Let's say you make roughly 75 grand a year. You can see in this example that the owner salary is included in overhead because in this example, the owner isn't tracking their hours towards specific jobs. If you want to get really dialed in on your job costing, then you can track your own hours and apply that expense to a specific job. But for the sake of simplicity, and in this statement, you can see that the owner just captures their salary as overhead because they do everything in the business, right? And that overhead will get attributed to the cost of the job in a different way. So look for those differentiators there. And that's how you can tell if your bookkeeper is a detail-oriented and categorizing things in the right way. If it's not clear the difference between your COGS and your overhead, or it's not clear what exactly is making up those specific line items on your overhead, then you definitely want to look into that or consider an upgrade to your process, okay? That's all I want to cover in the income statement conversation today. Yeah, that's all I want to cover in the income statement conversation today. like I said, you can go into many different avenues, but I think that's the first step, is to just ask your bookkeeper, your accountant, hey, can you give me my profit and loss statement for the year or for the month or whatever time frame you want, and to look at those specific categories to make sure that things are being done accurately. Because from there you can decide, okay, let's make some upgrades and let's collect some actual data. Now, in the next videos, please follow along. I will go into more depth. The next one I'm going to do is actually breaking down the gross and net profit percentages and relating them back to your budget or your estimate that you've given for a specific project. So stay tuned, and we'll cover the next more exciting step of the profit and loss, as to how to actually be strategic with it, how to make decisions that help you reach your next growth milestone. That's it for now. Thanks for tuning in. Like, subscribe, follow me on Instagram at Clementino3B, and hope you enjoyed the video today. Like, comment, subscribe. Cheers.